Rajesh Palviya as well joining in on the technical side. Rajesh, hi there. Good morning. It's expiry week. What is it that you're working with by way of levels on the index, given the fact that we've been circling around in a very tight range, as well as ahead of the big budget run-up event? And share with us some of your top trades.
Yeah, good morning. So definitely it's the fifth week where we stuck in the range of 17,700 to 18,300 for Nifty. And again, Nifty is, failed to cross this resistance area since last 4 5 weeks. So looking at the overall scenario and especially in last 3 4 trading session, what we have seen that, Nifty is now comfortably trading above 18,000 level after the recovery from recent low. And looking at the rollover activity also, we feel that some more upside momentum we can see towards this expiry week as well as ahead of budget. We are projecting Nifty target towards 18,180 to 18,200 in the continuation of this pullback which we have observed, especially in last week. Overall setup is looking promising for this week. Till we are holding above 17,960 970 zone, trend is likely to remain on the bullish side. So one can buy any dips towards 18,000 level with stop loss of 17,970, upside target 18,180, 18,200. On the other hand, Bank Nifty is looking very interesting. Almost it's now trading near to its immediate resistance area of 42,600, 700, which is acting as a resistance area. But looking at the component of Bank Nifty, we feel that if at all Bank Nifty manages to cross above 42,600, 650 zone, then there is one round of short covering we can expect in current week, as most of the call writers have created their position around those strikes. So if at all we crosses those levels, then one round of short covering we can expect in Bank Nifty, and then possibly Bank Nifty can move further higher towards 42,800, 43,000 level also. So buy on dips is the strategy for Bank Nifty also. One can keep stop loss of 42,200 to remain long in the Bank Nifty also. Moving to the stock specific, we feel that Dabur can be looked at the current market price. In the previous trading session, a strong buying action has been seen. Stock now trading about 20-day moving average, almost approaching to 50-day moving average. Looking at the traction in, especially in FMCG sector, we feel that Dabur can be outperformed. One can place a stop loss of 555 to go long in Dabur or upside target of 580. Another stock from mid cap space, that is APL Apollo. Very strong buying action throughout the week in the last week, and now stock is approaching to its previous swing high level. And looking at the overall setup for APL Apollo tubes, we believe that this momentum is likely to continue further. And upside target we are projecting around 1260 to 1280. One can buy in the decline also. Keep stop loss of 1155.
Okay, hang in there. So those are the top ideas we've gotten, and we continue to get for our viewers money making stock specific ideas. Here's Himang Jani with his list.
There are investors who are looking out for some stable, companies with a good revenue visibility on a consistent basis. So while these stocks have run up, I think given the increased defense spend and the higher visibility of revenue, people would really want to have a pie of that. And from that perspective, I think two names we like. One is Bharat Electronics, the other one is HAL. We do not cover some of the shipbuilders and many other categories which are there as a part of the defense ecosystem. But I definitely think that it makes sense to have some allocation to the defense theme given the very strong revenue visibility and the increased focus.
Straight on then, Vibha Padalkar is joining in, MD and CEO HDFC Life Insurance, to talk about the quarterly performance, and let's connect with her. Thank you so much for taking time out. Now, to begin with, your product mix has seen a sharp shift towards better margin products, including non-par. But margins, on a year-on-year basis, they've been flat. So how does one look at the mix?
you have to deconstruct this, wherein the margins that you see now are at a consolidated level post merger with Exide Life. So standalone margins have gone up, and by that I mean just HDFC Life and Exide Life's margins that were at high single digits is what we mentioned just before the merger. And that has got subsumed. So actually, we've reached a level of margin neutrality faster than what we had originally anticipated in terms of time that it would take. And to explain that, we have reached a margin of 26.5% on a 9-month basis, which is exactly the margin that was there 9 months of last year on a standalone basis. And so the synergy extraction process has started. And when you mentioned that the margins are flat, if you were to look at standalone margins for Q3, that has been 26.8%. And so this is demonstrating a smooth upward curve on margins.
So can I ask you, and even though however obvious it sounds, for the benefit of our viewers, will the product mix therefore continue to move towards the higher margins going forward? How deliberate has the strategy been?
We believe in a balanced product mix as well as balanced distribution mix, and we run our product choices at a suitability for the customer as well as what is the cost of acquisition at a channel level. So you will see pretty similar levels of product mix, wherein we have said that non-par will be about 30 to 35% thereabouts. And you will find that unit link to be about 20 to 25%, participating products to be about 30 to 33%, and the rest will be a combination of annuity and protection products. You will find very similar kind of a breakup in the year ahead.
So in terms of OPEX, is there likely an improvement in going forward as efficiencies with Exide Life as well will be kicking in?
Absolutely, and you'll find that looking at OPEX will not really give the correct picture. Reason is that Indian GAAP does not allow straight lining of costs as you incur, and we sell long tenured policies typically. So supposing we were to sell a 10-year policy, a large chunk of what we incur in acquiring that policy is upfront in year one, and that will be booked as OPEX in the year in which we incur it. Very similar to like cash accounting. However, the benefits of that policy will accrue over the next 10 years, assuming that the policyholder continues to pay their premiums. And so the other way of looking at this is in terms of new business margins, and that would show that are we writing profitable business.
Something else to talk about is, the agency channel that has seen a sharp shift in terms of the distribution mix. Can you share with us how much you would say is attributable to the agents?
It's a combination. Both companies have done well on agency channel. Our standalone, meaning pre-merger avatar of HDFC Life, has grown 2x in terms of versus company level growth, and the erstwhile Exide Life also has done well. And as a combination, from being about 14% of our business, agency channel now contributes about 18% of our individual business, and this is a stated objective that our agency as well as proprietary channel will start becoming more and more meaningful over the next 2 to 3 years. So we're well on track for that.
Good to know. And finally, HDFC Life has in the past expressed keenness in entering the health insurance space. Now that the IRDAI has given in life insurance this opportunity, is this now being actively considered? How quickly? And we've also got the upcoming merger. So could it be a possibility of a merger maybe with HDFC Ergo?
See, as the regulatory construct today, there is no question of us filing for anything in terms of whether it is health or any general insurance. Having said that, you will recall that back in time, HDFC Life, along with a lot of our peers, did show interest in also being able to sell health indemnity, especially in the context of having new products. And thereafter, a committee was formed. I was part of that committee. A report was submitted about 18 odd months, if not more, back. And thereafter, I chaired the Development and Penetration Committee, and that report was filed, in which again we sought being allowed to do health indemnity. So all of that shows that there is interest, but I think we'll have to see in what form or shape there is regulatory facilitation for us to take a call. Another thought process is that we don't have to manufacture everything. There are some core competences that we have. We can be in partnerships. We already work very closely with HDFC Ergo, and we do have a combination product which is doing very well. They have an Optima secure product, and along with ours, Click to Protect Avatar, so doing well. So we'll do more of that. So there are various models that can emerge. The intention here is that how do we expand the pie? How do we have more product innovation? How do we make it easier for the customer? Today, the customer to buy Mediclaim has to go there, to buy cancer care goes somewhere else, health saving is somewhere else, overseas medical is somewhere else. So how do we make it easier? I think those are the aspects that really consume us.
Okay, Vibha, we're going to leave it at that. Thank you so much for joining us today and dissecting the earnings as well. What to watch out for HDFC Life. Currently, the stock, for the last 1 year has given a negative return of 5.5%. With that, Naresh, I'd like to come to you. And, we've just heard from the top management of HDFC Life, but it's actually the HDFC Bank that I wanted to talk to you about. We've seen the earnings that have also come out, and we've now seen the private sector lenders come out with their numbers. And the question, Naresh, is can HDFC Bank in 2023 be what ITC was in 2022? We've been waiting for this elephant to dance, and it started to.
So the difference is when we go to ITC, it was FII selling which led to the bottom, and once the FIIs became buyers, the trend changed. The problem with HDFC Bank is it's an event which has been a concern for a long period of time. So if you look at the price action over the last 2 years, the stock topped out at 1600 in 1640 in 2021 Jan. That is where most of the banking and financials topped out. Post that, it made a recovery to 1700 plus levels in October 21. Fell all the way down to 1300 in February, March 22. Then we saw this big event announcement, and again we topped out around 1720. Over the last 3-4 months, we've made a top around 1650, 1670. So technically, if we can sustain about 1700, it could be a stock which could go towards 2000 also. So this could be the stock which could decide the whole trend for the Nifty and the Bank Nifty, given that it has a weight of, say, if you could keep a combined weight of HDFC Twins, that's a weight of 16 to 18% on the Nifty, and on the Bank Nifty 27% weight as of now only when there is HDFC Bank. And going forward, if the both merge and it becomes a part of Bank Nifty, it would be much higher. So technically, we are shaping for that eventual breakout about that 1700 mark. When it happens, whether it happens post an event or we keep seeing a slow updrift is a difficult call. But overall, technically, we've made a base around 1550 to 1550 levels. So it's a buy on dips going forward. If one has a contrarian view, it could be the surprise pack for the next 1 year, maybe even 1.5 years.
Right, okay. Adani Enterprises, the top boss, Gautam Adani, shared the intent behind the company's 20,000 crore rupee FPO. He says the intent of the FPO is to bring in new public equity. Hear out what he had to say.
Our FPO comes at a unique point of time, a time when we are at our strongest, with most of our growth is still ahead of us. This Adani Enterprises FPO is a part of our 10-year capital planning cycle, supported by a fully funded and a de-risked growth plan that is aligned with the India's growth story, aligned with our capabilities, and aligned with the needs of our India's retail shareholders. Our intention with the FPO is to expand our share registry with a specific focus on India's retail investors. The FPO is a validation of our intent to bring in new public equity investors as our shareholders. I welcome new investors to come and join our extended shareholder family.
All right, Gautam Adani, they're talking about the intent of the FPO. Let's get a move on then. Lots of stocks on our radar, but we've got two on the editor's radar. They're both brokerage notes, so let's get straight to it by discussing Bharti Airtel first up. That's the stock that we're pointing out. Now, Morgan Stanley has come out with their latest research note. They're saying that it's a good opportunity to buy the stock on dips, and they maintain an overweight rating. They've got a target price of about 860 rupees thereabouts. And Nikunj, just looking at what we've seen pan out for a Bharti Airtel so far, they've said that it's a good defensive name to have in the portfolio. It's definitely a must, right?
The stock has corrected. So when we spotted the stock, of course, it was north of 800, and from there it has come down almost to 750, 760. One thing is clear that 5G is not going to be as bumper as what everybody thought. But Bharti, given its positioning that worst of the price war is behind us, ARPU directionally they should go higher. Reliance Jio, the numbers from Reliance Jio are looking weak. So it is not that the entire telecom sector is contracting. Reliance Jio, the high bumper market growth gain era, I think, is behind us, and that is where I think Bharti would benefit. The macros are also very challenging, and they will remain challenging for this year, whether it is on inflation or recession. Typically, that's the time defensive stocks outperform. So this will qualify as a stock where you would say, I cannot buy it for a 30% gain, but I may want to buy this stock in my portfolio more like an hedge, more like a stock which should fall less, given how the contours globally are going to be challenging, and locally also 5G rollout, well, it's going to cost upfront and benefits later. But frankly, after the Jio numbers, there is hope that burst is clearly behind Bharti.
Okay, absolutely muted. That's a 3-month chart, down about 4.7% on Bharti Airtel. Let's get a move on then and discuss the next stock on the editor's radar, and that's IDFC First Bank. CLSA in their latest note has upgraded the stock. They believe that post the Q3, it's a compelling buy recommendation, and they've got a target price at 75 rupees. They've also spoken about how the core PPOP growth is forecast at about 33%. They're seeing liability traction as well for the stock going forward. Your views?
You typically want to look at mid-tier banks which have ability to garner great CASA. They are giving rates which are higher than the industry average in terms of fixed deposits, so the CASA is actually strong. But that in hindsight actually benefited a franchise like IDFC Bank. Second, being a small bank, the ability to grow is certainly much higher than the industry average. And now hopefully that overhang of IDFC Limited and IDFC Bank merger will go through. It's not happened. It was expected to happen last quarter. It has not happened. Small bank, not very expensive, decent CASA growth and ability to grow, and the trigger really could be the merger between the bank and IDFC Bank. So net it's a stock from the mid-cap banking space which you would say could be an outperforming stock. Even though it has outperformed, I think it has these contours of an outperformance still left.
Okay, contours of an outperformance still remaining for IDFC First Bank. There you go, Nayantara. Those are the stocks on the editor's radar.
Okay, so stocks on the editor's radar there. Watch out for all of them, and now you know why too. Sandeep Sabharwal is here with us. Good morning, Sandeep. Should we begin with the big earnings that came out on Friday post-closing bell, and what you made of them? Reliance Industries.
So Reliance results per se were perfectly fine, like in terms of the operating profit margin, delivery, and performance across the businesses. Jio was slightly slow, but then that's fine. That was expected. The two points which keeps the valuations down is one, the debt levels again are increasing rapidly. With huge capex reported in this quarter, also around 38,000 crores. Net debt has gone up to 1,13,000 crores. Interest costs went up sharply as a result in this quarter. And this is despite none of the new businesses they had announced investment into hydrogen, etc. Actually picking off. So I think that keeps the valuation down for Reliance. They had a target of zero net debt. So that doesn't seem to be either possible or imminent right now.
Right. Sandeep, hi, morning.
That's that on Reliance, but it's going to be a tough battle between ICICI Bank and Kotak, I think. You think Kotak would impress the street more considering the consensus ICICI Bank already is?
You could be right because simply because of the fact that Kotak Bank has underperformed so much in the recent past, mainly due to valuation concerns. Those valuation concerns haven't gone away. Like in terms of valuations, it still is expensive relative to both HDFC Bank and ICICI Bank. At a time when most growth parameters for all banks are virtually similar. So I would think that Kotak Bank results are good, its value of subsidiaries expanded, but it's still more expensive than the other banks. ICICI Bank results was difficult to find out anything negative except for the lower deposit growth vis-a-vis credit growth. And as they try to gain more deposits, how that impacts their margins, that's something we need to see. The most positive thing about I think ICICI Bank is their contingency reserves. So they have built up contingency reserves of 11,500 crores, while the net NPA is just 5,500 odd crores. So effectively they are at zero net NPAs, which is an exceptional performance, and their uh, provision coverage ratio at 82% is the highest in the banking industry. So my guess is that, and it's still 20-25% cheaper than HDFC Bank. My guess is it will continue to be one of the better performing banking stocks over the next 2-3 years.
Okay, that's the view coming in. Let's discuss it on the charts then. And Naresh, ICICI Bank versus Kotak.
It's a tough call given that ICICI Bank has been an outperformer for the last couple of years, but Kotak Mahindra Bank has been a terrible underperformer. Say the stock price is available at the same price where it was pre-COVID almost. So pre-COVID the stock was at 1700 and now we are at 1760 roughly. If you go to ICICI Bank pre-COVID, it used to be 500, 550, and today we are at 870. So it's a tough call, but technically the way to look at it is we continue to believe the outperformers till the time it continues to do so. As of now, we see Kotak Mahindra Bank still at the 52-week close. So once it starts recovering, that is the point of time I would change the track. As of now, I would expect ICICI Bank to do better in the short term as well as the medium term.
Okay, so that's why you've got the banks very much in focus. And Sandeep, let's ask you about this, the big beats that we've seen from Kotak Mahindra Bank. Till now, so much has been said about ICICI Bank and has been the preferred private sector lender in that sense to bet on. Can that change? Is it now the turn of Kotak?
So the near term, it's very tough to predict, but I think longer term, Kotak Bank still trades at a significant valuation premium to both HDFC Bank and ICICI Bank, and there's no reason for that premium to actually exist because the phase where these some of the banks were smaller and they were growing much more rapidly than the bigger banks. That phase is over. Kotak itself is a big bank now. So again, the point comes down to what Naresh was saying. Given its huge underperformance, it's possible that it can outperform in the near term. But then, given that its valuations are much higher than that of most larger banks, uh, it will be tough for it to outperform significantly. So that's what my view would be.
Okay, I'm going to shift gears completely and talk about metals. Sandeep, why are metal stocks growing higher? Is it because world is convinced that growth is back?
I think there are three factors. One, they got beat down so much that as the Chinese reopening story came up, the prices started moving up. Secondly, in a downturn, destocking happened, so no one was building inventories, and as soon as prices started to uptake, there's an inventory build-up cycle which starts, and that leads to prices moving up further, and that's playing out in the commodity companies. Clearly, margins seem to have bottomed out, and that is driving the stock prices. But I don't think we'll see a spiraling up move because global economies are still going to weaken, and this Chinese reopening theme will play out for some time before people realize that they are going to be in a structural downturn now for several years. And to that extent, there might still be some time to play this uh, move in metals, but not long term, I would say.
Okay, I'm going to just go back to IT because IT has shown signs of mild outperformance, whether it is persistent or Infosys. Nuresh, is there a trade in any of the IT stocks?
So it's a tough trade wherein one has to go contrarian here. So the contrarian trade is to start looking at stocks which have underperformed, wherein you get the whole list of small cap IT names, which is where we've seen underperformance for a long time, which is basically you go to LTTI, LTTS, LTI Mindtree, if one is looking out for an outperformance. From here on, we've seen a good bounce in TCS and Infosys in the near term. The risk reward is not great. Overall the trend has changed. So one would, if one wants to play IT, one has to go a little aggressive, go at the smaller names, which would basically be a gamut of a basket of LTTS, LTTI, LTI Mindtree, a Birlasoft or something like that. In the large cap space, I would expect a slow and steady move. The risk reward is not great. A 5% upside and a 5% downside is what I go with at the current levels.
Right, okay. That's the take coming in on some of the active movers. Also, interestingly, while we did see a bit of a perk up coming in on IT, but yes, LTTS for instance, on Friday fell about 5%, but you had a Coforge on the same hand, which held out by about almost 4% or so. Sandeep, anything to read into the recovery in IT names, sporadically albeit, but they're making an attempt at least, or you think this is just a trading move?
I think it's mainly due to two factors. One, although the results are not as great, the outlook given by most of the companies was not as negative as what people were expecting. Secondly, in the US, inflation seems to be slowing down without a huge decline in the economic activity, at least as per the data which is available now. So maybe the interest rate hikes will impact the economic growth going forward. So I think these two factors are creating some positivity. On the flip side, the rupee depreciation aided the profitability of IT companies among potential margin pressures in 2022, given the huge depreciation of the rupee. Now that depreciation seems to be stalled as the dollar depreciates, and already in this quarter, I think the rupee is already up 2.5% and which could actually continue till March, and we could see further appreciation. So that could become another headache for IT companies. So on balance, I would say risk reward is not set such so great now for buying into IT stocks broadly across the board.
All right. Meantime, it's going to be a hectic day on the earnings calendar today as well. There's Axis Bank, but other than that, you've got the likes of Karur Vysya Bank, Gland Pharma, Root Mobile, Canara Bank, Syngene, etc. that will be coming out with their quarterly numbers. So the street will closely be eyeing this as well. Wanted to get in your take then, Sandeep, as to what exactly you'd be watching out for when it comes to an Axis Bank's number.
I think trend should be similar as what we've seen in other banks where CASA ratio is high and NIM expansions to recent highs or multi-high levels, improvement in balance sheet. And I think from Axis Bank specifically, people will be looking out for some commentary on the Citibank integration, how that's going and how much they'll be able to retain out of the clients they potentially acquired due to that acquisition because they paid a substantial amount for that. So I think that's something which will be the more important factor for Axis Bank.
Okay, let's quickly tell you what else is happening outside the world of markets. In China has reported nearly 13,000 COVID-related deaths in hospitals between Jan 13th and 19th alone. The death toll came a week after China said that nearly 60,000 people had died with COVID in hospitals in just over a month. Also, people across China rang in the Lunar New Year on Sunday with large family gatherings and crowds visiting temples after the government lifted its strict zero COVID policy, making things even worse and marking the biggest festive celebration since the pandemic began 3 years ago. And also, 10 people are feared dead, another 10 hospitalized after a mass shooting in California. The shooting happened at a dance studio near a Lunar New Year festival celebration. Authorities have yet to reveal a possible motive for the shooting, but said that 72-year-old man who opened fire died from suicide after his vehicle was surrounded by cops. Also, federal prosecutors have seized nearly $700 million in assets from FTX founder Sam Bankman-Fried in January, largely in the form of Robinhood stock. Bankman-Fried, who has been accused of stealing billions of dollars from FTX customers to pay debts incurred by his crypto-focused hedge fund, has pleaded not guilty to fraud charges. He is scheduled to face a trial in the month of October.
Moving on, the Indian Navy is set to commission its fifth Kalvari class submarine named Vagir today. INS Vagir has been built indigenously by Mazda Dock Shipbuilders in Mumbai. 4 Kalvari submarines have already been commissioned to the Indian Navy, while Vagir is going to be the fifth. India, meantime, crashed out of the Hockey World Cup 2023 after losing to New Zealand in a sudden death for 5 at the stadium. The teams played out a 3-3 draw at full time, taking the match into the shootout where India lost to New Zealand. And while the nation pays tribute to Netaji Subhash Chandra Bose on Parikram Divas, the Prime Minister will be participating in a ceremony to name 21 largest unnamed islands of the Andamans and Nicobar Islands. They are named after the 21 Paramveer Chakra awardees, and he will also unveil the model of the National Memorial dedicated to Netaji to be built on Netaji Subhash Chandra Dweep. Moving right on, the preparations for Republic Day celebrations are on in full swing. The full dress rehearsal for the parade will be held in New Delhi from 10:30 a.m. today. It will be starting from Vijay Chowk and proceeding to Red Fort. There's elaborate traffic arrangements that have been made for the smooth conduct of the parade along the route.
Oh, absolutely. If you were in the national capital right now, so many parts of the national capital, particularly in central Delhi, already being cordoned off with preparations and dress rehearsals, full swing for Republic Day. On Thursdays, of course, a truncated trading week as well, with Thursday being a holiday. I'm now going to focus on all the kind of stocks that we've seen in the week gone by, where there has been price action backed by higher volumes than usual. I'll begin with the stocks where we saw actually price action being in the green, backed by high volumes. And Rajesh, let me come to you for this one. Some of them that stand out with this: Mastock, Sham Metal, and even a Soba.
So out of these, none of them really come up on the radar in a big way, because Mazagon Dock has gone through a big move and then a little correction, and now is making a sideways move. Soba, on the other hand, has seen a sideways move altogether. So out there also, it's a small breakout on a very shorter term time frame. The last 2 weeks, it was very tight range, roughly 10 points range for the last 10 days. Yesterday was a little breakout, but a bigger breakout comes about that 680 mark, which is still far away. So overall, these 3 names, you've seen a one-day move. These 3 names would watch out if there is a follow-on move today. As of now, it looks more like just a one-day flash.
Looks like just a one-day. I mean, actually, real estate, if I think about it, has disappointed. Despite all the fact that, okay, real estate demand is going to be coming back, it's going to be a 10-year bull market which has started. Frankly, real estate stocks, after that deep swell, let's say what that in 2021 and better part of 2022, last couple of months, real estate stocks have done nothing. Let's look at it. Oberoi, Prestige, DLF, Shobha, am I missing on anyone? Max Ventures, small one. These stocks have actually done nothing. Sanjeev, why is that? Real estate was supposed to be in a bull run, and real estate stocks were supposed to follow the real estate bull run.
So a major part of the gains came in 2020-21 only. So I still remember we exited DLF around 420 levels more than a year back, and now even now it's at 370.
So my logic was that the stocks ran up too much too fast, and they are the most interest rate sensitive segment. So as interest rates rise, it will be tough for their valuations to move up. And thirdly, while margins have been strong, the pricing in real estate has not been as strong, and to that extent, there are concerns that margins could take a hit. So I would think that the real estate will come back. Like you said, it's going to be a long cycle. It's still in up cycle. But from the stocks perspective, I would think that we will have another move as the valuation consolidation ends and the interest rate hike cycle ends.
Hmm. Just looking at the long list of earnings, and while we are going to be focused first on seeing the reaction to Reliance, to ICICI Bank, and to Kotak, there is also that follow through that you may have of the Adani Enterprises FPO perhaps. There's JSW Steel also, which has come out with a number, and the numbers are a beat. The margin, consolidated EBITDA have all managed to beat the street estimates. There's IDFC First Bank as well, which came out with its numbers. Both NII and the profits have managed to beat street estimates there. Yes Bank as well, the asset quality has improved on a sequential basis. NIMs at 2.5% are definitely better than what the street was also anticipating. And then of course there's RBL Bank as well, wherein the NIMs have come in at a 10-quarter high of 4.74%. Sandeep, I don't know how closely you're tracking an RBL, IDFC or a Yes Bank for that matter.
Yeah, IDFC I'm tracking, so I think they're on the right route with their change in strategies, both in terms of lending as well as garnering deposits. And it's been a huge outperformer also. So valuations have moved up in the near term. So I would think that huge upsides might not be imminent in the near term, but directionally this bank should continue to do well. RBL and yes, I'm not looking at.
Thanks very much, Sandeep, for joining in. Let's get in those top mid-cap strategies going from our chartists as well. And Naresh, what is it that you're tracking on the charts?
So that's a small cap company called Bharat Bijli Limited. What we've seen is a strong trend across the whole capital good related space. So Bharat Bijli is a transformer company which has been making a nice higher top, higher bottom formation. The stock has come very close to a 5-year high and has continued to do well. So expecting the next leg of the move in the near term, it has been pausing around the 2500, 2550 mark. Once this sustains, we could see a quick move towards 2800. So buy at current levels as well as on dip with a stop loss at 2350 and a target price of 2800.
And Rajesh, what are your picks from the broader market?
So from mid-cap space, yes, APL Apollo Tubes is looking attractive. 1260, 1270 we are projecting target. One can buy with stop loss of 1155. Another stock from mid-cap IT, that is Persistent, is looking promising. In the previous week, strong buying action we have seen in the stock, and looking at the overall setup, stock is showing strength on the near-term, short-term setup. So we believe that Persistent can continue its up move. We are projecting target of 4420, 4460 on the higher side. So one can buy Persistent system with stop loss of 4270.
Right, okay, let's tell you all about the index calls this morning, given that it's a strong handover from the global cues. But yes, we're leaving behind a very flat Nifty performance week. This one, lots of earnings. You'll have a truncated week with 26 January being a trading off, and then of course F&O expiry as well. So a buy coming in from Rajesh, a hold from Naresh Mirani as well as Kush Bora. What's the moodometer? Well, it seems like a consensus hold regardless. What about the Nifty Bank then? Considering it's a very earnings heavy week for Nifty Bank and a large part of the earnings are already in the bag, which the market is going to be reacting to today. Many of them came by post market hours on Friday and of course over the weekend as well. So Kush Bora has got a hold, and similar is the strategy coming in from Naresh as well. So it's a consensus hold on the Nifty Bank as well.
Yep, just about 9:05. So let's find out the cover on the street today. Pankaj has been working his phones with the dealing room check and now joins in with the latest. Pankaj.
So there are a lot of results which of course you all have discussed from the start of the show. So all of these large names will see a lot of volumes. But interesting thing what a few dealers do tell me is that the Chinese markets are shut because of their new year, and FIs were big sellers. They were selling Indian market and buying the Chinese market. So the interesting thing is whether this trend continues this week or not is something to watch out for, because they can sell India but they cannot buy China. So people will wait and watch out for that particular trend. They expect volumes to be low. Secondly, you have the budget, which is of course on 1st Feb. Now if you just count out the days, exclude 26th of Jan from that, there are just about 7-8 working days remaining as far as this particular budget is concerned, and that's why the run up to budget, positioning ahead of budget, will start. Despite earnings, despite FNO action, you will see a lot of that positioning happening in, and that should start from today. The interesting bit is that insurance companies have declared okayish numbers, whether it's whatever that have come so far have been okay, but Q4 or this Q4 is expected to be very, very strong, and that's why there is some interest over there. So what happens to HDFC Life on a second day after results? SBI Life, now a big name, has declared numbers post market hours. So let's see how do these names react. But people are saying that there is some value buying as far as insurance names are concerned in expectation of a strong seasonal Jan to March quarter.
Yeah, Pankaj, many happy returns of the day from the entire team at ET Now. And is it going to be cake, jalebi, samosa? What is it that you're getting for us today?
Rajasthan.
Well, Awan and team, thank you so much for that. I think that let's keep it a surprise post the show. Whether it's namkeen, mithai, or anything else, let's see.
Okay, can't wait. Thanks very much for joining in. But let's, in the meantime, connect then with Charandeep Singh, founder and managing director at Girik Capital, as well as Varun Daga, who's the co-founder and fund manager. Thanks so much, gentlemen, for taking time out and joining in. It's expiry, and then, of course, the big budget event comes.